What if the money sitting in your bank account right now is not actually there? What if the bank already lent it to someone else and is using your savings to make money for itself? That is exactly what is happening, and most people have no idea. Before we get into how banks really work, think about the last time you deposited money. You probably felt safe knowing it was stored away. But the truth is, banks are not vaults. They are machines designed to multiply money, and most of us never learned how. The story of banking goes back thousands of years. Long before digital transfers and credit cards, ancient merchants in Babylon and Greece needed somewhere safe to keep their gold and grain. They trusted temples and wealthy traders to hold their valuables. That was the first version of a bank. These early keepers of wealth quickly noticed something interesting. People rarely came back for all their gold at the same time. So they started lending some of it out to others and charging a fee for that. That fee had a name. We call it interest. That simple idea, keeping money safe and lending it out for a fee, is still the core of how every bank works today. Whether it is a tiny credit union in a small town or a massive global bank with trillions on its books, the basic engine is the same. So here is the deal. When you put your paycheck into your bank account, you are not renting out a little box where your dollars sit untouched. You are actually lending your money to the bank. Yes, you heard that right. You become the lender, and the bank becomes the borrower. In return for letting the bank use your money, they promise to give it back whenever you ask. That is the core agreement between you and your bank. They also pay you a small amount of interest on savings accounts, though today that amount is usually quite small. Now the bank takes your money along with everyone else's deposits and uses that pool of funds to give out loans. Home loans, car loans, business loans, personal loans. Every time someone borrows from the bank charges them a higher interest rate than what it pays you. That difference between the interest rate the bank pays you and the rate it charges borrowers is called the interest rate spread. This spread is one of the primary ways a bank makes its money. The wider the spread, the more profit flows into the bank's pockets every single day. But here is where things start getting really interesting. Banks do not just lend out the exact money they collect from depositors. They actually lend out far more than what they have on hand. This sounds impossible, but it is completely legal, and it has a name: fractional reserve banking. Here is how fractional reserve banking works. Imagine 100 people each deposit $1,000 into a bank. That is $100,000 total. The bank is required to keep only a small fraction of that in reserve, maybe 10%, which is $10,000. The rest it lends out. So $90,000 gets lent out to borrowers. Those borrowers spend that money on homes or cars or businesses. The people who receive that money often deposit it back into the banking system. Now the banks have more deposits and can lend out even more. This cycle keeps going. What this means is that the original $100,000 in deposits eventually creates hundreds of thousands of dollars in loans circulating through the economy. Banks essentially create new money through lending. This is called the money multiplier effect, and it is the engine that drives the entire economy forward. Now you might be wondering, is this safe? What happens if everyone decides to take their money out at the same time? That scenario has a name too. It is called a bank run, and it has brought down some of the most powerful banks in history. More on that soon. First, let us understand the different types of accounts banks offer you. The most basic is a checking account. This is the everyday account most people use to receive their salary, pay bills, and make purchases. It is designed for frequent use and usually earns little to no interest. Then there is the savings account. This is where you park money you do not plan to spend immediately. The bank pays you a slightly higher interest rate here because you are agreeing to be less active with this money. It rewards patience, even if just by a small margin. Beyond those basics, banks offer certificates of deposit, often called CDs. With a CD, you agree to leave your money with the bank for a fixed period, maybe 6 months or 2 years. In exchange, the bank pays you a higher interest rate. The longer you wait, the more you earn. There are also money market accounts, which combine features of checking and savings accounts, and various investment products. Banks have expanded far beyond just keeping and lending money. Today they sell insurance, manage investments, and offer credit cards. They have become full financial service companies in many ways. Speaking of credit cards, let us talk about one of the most profitable products banks have ever invented. When you use a credit card, the bank is essentially giving you a short-term loan every single time you swipe. If you pay it back fully, that is fine for you. But if you carry a balance and only make minimum payments, the bank charges you interest rates that can range from 15 to 25% or even higher. For every $100 you do not pay back immediately, you might owe an extra $20 or more over the following year. This is how many people end up in a cycle of debt without even realizing it. The minimum payment barely covers the interest that has built up, so the actual balance barely shrinks. Banks designed it this way. It keeps money flowing back to them month after month after month. Now let us come back to that scary word we mentioned earlier, a bank run. In 1929, during the Great Depression, people heard rumors that banks were in trouble. Suddenly, everyone rushed to withdraw their savings at once. Banks did not have enough cash on hand, and many collapsed overnight. Thousands of banks failed. Millions of people lost their entire life savings. Businesses shut down. Unemployment skyrocketed. The whole economy unraveled, partly because the banking system cracked under panic. This was one of the most painful economic lessons in modern history, and it changed banking forever going forward. After the Great Depression, governments stepped in to make sure this could never happen again. In the United States, they created the Federal Deposit Insurance Corporation, known as the FDIC. This agency insures your bank deposits up to a certain limit, currently $250,000 per depositor per bank. What that means for you is that even if your bank completely collapses tomorrow, the government will give you your money back up to that insured limit. This safety net removed the main reason people had for panicking. Knowing your money is protected makes you far less likely to run. But insurance alone was not enough. Governments also created central banks. In America, that is the Federal Reserve. The Federal Reserve is the bank for banks. It lends money to regular banks when they are in trouble, sets key interest rates, and tries to keep the entire financial system stable. When you hear on the news that the Federal Reserve raised or lowered interest rates, that is a big deal, because whatever rate the Fed sets ripples through the entire economy. Mortgage rates, car loan rates, savings account rates, and even the cost of running a business all shift in response. If the Fed raises rates, borrowing becomes more expensive. People take fewer loans. Businesses invest less. The economy slows down. If the Fed lowers rates, borrowing gets cheaper. More people take loans. Businesses expand. The economy speeds up. This is how central banks try to steer the economy like a ship. Now let us zoom out and look at the bigger picture of how banks make money, because interest on loans is only one piece. Banks also charge fees, overdraft fees, monthly maintenance fees, wire transfer fees, ATM fees. These small charges add up to billions of dollars for banks each year. Banks also make money through investment banking. This is the side of banking most people never see. Large banks help companies raise money by issuing stocks and bonds to the public. They charge big fees for arranging these deals. One successful deal can earn a bank tens of millions of dollars. Then there is trading. Big banks buy and sell stocks, bonds, currencies, and other financial instruments with enormous sums of money. When these trades go well, the profits are massive. When they go badly, the losses can be just as massive. This part of banking carries serious risk for everyone involved. This brings us to the 2008 financial crisis, one of the most dramatic collapses in banking history. Banks had been giving out home loans to people who had very little ability to repay them. These were called subprime mortgages, and banks were doing it on a massive scale across the country. Why would banks lend money to people who could not pay it back? Because they found a clever trick. They bundled these risky loans together into complex financial products and sold them off to investors around the world. Once they sold the loans, they no longer worried about whether they got repaid. The problem was that these products were so complicated that almost nobody understood how risky they truly were. Rating agencies gave them top grades. Investors bought them eagerly. Banks kept making more loans to keep the machine running. Everyone was making money, and nobody wanted to slow down or ask hard questions. Then home prices started falling. Borrowers began defaulting on their loans. The complex financial products backed by those loans began losing value rapidly. Investors panicked. Banks that had loaded up on these products suddenly faced catastrophic losses. The whole system, built on layers of risk nobody truly understood, began to unravel fast. Lehman Brothers, one of the biggest banks on Wall Street, filed for bankruptcy in September 2008. It was the largest bankruptcy in American history at that point. Financial markets around the world went into freefall. Credit froze. Businesses could not get loans. Regular people started losing jobs by the millions. Governments around the world had to step in with massive bailouts to prevent a total collapse. In the United States, the government spent hundreds of billions of dollars rescuing banks that were considered too big to fail. The idea was that if these banks collapsed, they would take the whole economy with them. It was a deeply controversial decision. Many people were furious that banks which had taken reckless risks were being rescued with taxpayer money while ordinary families were losing their homes and their jobs. The debate about fairness in the banking system that started then is still very much alive today. In the aftermath of the crisis, governments introduced new rules to make banking safer. In America, the Dodd-Frank Act was passed. Banks were required to hold more capital in reserve. Risky trading activities were restricted. Regulators got more power to watch over what banks were doing with everyone's money. Banks lobby hard against rules they find too restrictive. Over the years, some of those post-crisis regulations have been watered down or removed. The debate over how much freedom banks should have versus how much oversight they need never really goes away. Now let us talk about something that affects almost everyone at some point. Getting a loan from a bank. When you walk into a bank and ask for a mortgage or a car loan, the bank does not just hand you money. It goes through a very careful process first. The bank checks your credit score. This is a number that reflects your history of borrowing and repaying money. A high score means you have been responsible with debt, and the bank sees you as a low-risk borrower. A low score means the opposite and can make getting a loan much harder. The bank also looks at your income, your existing debts, how long you have been employed, and the value of whatever you are buying. For a home loan, the house itself serves as collateral. That means if you stop making payments, the bank has the legal right to take the house back from you. This process is called underwriting. The bank is essentially calculating the probability that you will pay them back. The riskier you look on paper, the higher interest rate they will charge you, or they may decline to lend to you at all. This is both a science and a judgment call. Once your loan is approved, you start making monthly payments. Each payment is split between two parts. One part goes toward paying off the actual amount you borrowed, which is called the principal. The other part pays the interest the bank is charging you. In the early years, most of your payment is interest. This structure, called an amortization schedule, means that in the first years of a 30-year mortgage, you are barely reducing what you owe. The bank collects most of its profit early in the loan. By the time you get to the final years, your payments mostly go toward the actual balance. Understanding amortization can save you a lot of money. If you make even small extra payments early in your loan, you can dramatically cut down the total interest you pay over time. Some people save tens of thousands of dollars this way, just by paying a little extra each month consistently. Now let us talk about something millions of people use every day without fully understanding it. Compound interest. Albert Einstein reportedly called it the eighth wonder of the world. When it works for you, it is one of the most powerful wealth-building tools that exists anywhere in finance. Here is how compound interest works. You deposit money and it earns interest. Then that interest is added to your balance and it also starts earning interest. Then that new interest earns interest too. The amount grows on itself over and over. The longer you leave it, the faster the whole thing snowballs. The flip side is also true, and this is where banks quietly benefit. When you carry debt and do not pay it off, the interest you owe compounds against you. Your balance grows on itself in the same way. Over time, a manageable debt can balloon into something overwhelming if left unattended. This is why financial experts constantly tell people to pay off high-interest debt as fast as possible. Credit card balances compounding at 20% interest will double what you owe in just a few years. The same math that builds wealth in savings accounts destroys it when you are the borrower. Let us shift gears and talk about how banks operate day-to-day on the inside. A bank is really just a very sophisticated business with many moving parts. At the front end, you have the branch staff, tellers, loan officers, and customer service representatives dealing with everyday customers directly. Behind the scenes, there are teams managing risk. They are constantly monitoring the loan portfolio to make sure not too many borrowers are defaulting at once. There are compliance teams making sure the bank follows all the regulations. There are technology teams keeping the systems that process millions of transactions daily running smoothly. There are also treasury teams managing the bank's own money. They decide how much to keep liquid for daily operations, how much to invest in government bonds, and how to balance the interest the bank earns against the interest it owes to depositors. It is a constant balancing act happening every single day. And then there are the executives setting strategy, which markets to enter, which types of loans to focus on, whether to acquire other banks, how to compete with rising digital banking competitors. Running a major bank means making enormous decisions that affect millions of customers and can shake entire economies when they go wrong. Let us talk about digital banking because it has completely changed how most people interact with banks today. 20 years ago, if you wanted to check your balance, you went to a branch or called a number. Today, you can do almost everything from a smartphone in seconds from anywhere in the world. Mobile banking apps let you deposit checks by just photographing them. You can transfer money instantly to anyone with a phone number. You can set up automatic savings rules, freeze your card if you lose it, track every transaction in real time, and even apply for loans without ever speaking to a person. This shift has saved banks enormous amounts of money. Maintaining physical branches is expensive. Staff, rent, utilities. As customers move online, many banks have been closing branches. Some banks now operate entirely online with no physical locations at all. These digital-only banks often pass the savings on by charging fewer fees. Neobanks, as these digital-only institutions are called, have attracted tens of millions of customers worldwide, with promises of no fees, beautiful apps, and higher interest rates on savings. Traditional banks have been forced to improve their digital offerings just to keep up and retain customers who now have more choices than ever. But there are trade-offs. When something goes wrong with a digital bank, there is no branch to walk into. Customer service can be slow or hard to reach, and some neobanks have faced serious questions about whether their deposits are truly insured and protected the same way traditional bank deposits are. There is also the rise of fintech more broadly. Companies like PayPal, Venmo, Cash App, and dozens of others are doing things that used to be exclusive to banks. Sending money, offering credit, processing payments. They are chipping away at services banks once had a monopoly on and forcing real change. Now here is something most people never think about. Banks are deeply tied to the government in ways that make them unlike almost any other business. The government regulates banks. The central bank backstops them. Deposits are insured by public money. Banks help governments sell debt by buying government bonds regularly. This relationship creates an interesting problem. Banks know that if they get big enough and risky enough, the government will likely rescue them rather than let them fail. This knowledge can encourage reckless behavior. Economists call it moral hazard. When someone else pays for your mistakes, you might take risks you otherwise would not. Reformers have long argued that banks should not be too big to fail. If a bank knows it will never be allowed to go bankrupt, it has less reason to be careful. Some economists say the solution is breaking up the biggest banks into smaller ones that can fail without destroying the entire economy. Others argue that large banks are actually more stable and efficient. Bigger institutions can better absorb shocks. They have more resources for risk management and technology. And breaking them up might make the system more fragmented and harder to regulate effectively. This debate has no easy answer and continues among experts today. Let us talk about something that affects your daily life more than almost anything else in banking. The interest rate on your mortgage. When rates are low, buying a home becomes much more affordable. When rates are high, the same home becomes dramatically more expensive, even if the selling price never changes at all. Here is a simple example to make that real. Suppose you borrow $300,000 for a home. At a 3% interest rate, your monthly payment over 30 years would be around $1,260. At a 7% rate, that same loan cost you almost $2,000 a month. That difference of nearly $800 a month adds up to almost $10,000 a year. Over 30 years, you would pay nearly $300,000 more in interest at the higher rate. The same house, the same loan amount, but a wildly different total cost, depending solely on the interest rate. This is why when the Federal Reserve announces a change in rates, the housing market reacts so strongly. Buyers who could afford a home at lower rates suddenly find themselves priced out at higher ones. Sellers find fewer buyers willing or able to pay. The ripple effect touches nearly every part of the economy. Banks themselves are very sensitive to interest rate changes. When rates go up quickly, banks can sometimes struggle. Their existing loans were made at lower rates, but now they have to pay higher rates to attract depositors. This mismatch between what banks earn and what they owe contributed to bank failures in 2023. Silicon Valley Bank was one of those failures. It had put enormous amounts of customer deposits into long-term government bonds when rates were low. When the Fed rapidly raised rates, those bonds lost value. Customers panicked and withdrew funds all at once. The bank ran out of cash and collapsed within days. It was a modern bank run, played out through smartphone apps instead of physical lines outside branch windows. News spread on social media. Messages flew across group chats. In the digital age, a bank run can unfold in hours rather than days. The speed of information now makes banking stability even more fragile. The government stepped in again and guaranteed all deposits at Silicon Valley Bank even above the normal insured limit. This calmed fears and prevented the panic from spreading to other banks. But it once again raised the question of whether the safety net for banks is now so complete that risks are never truly punished. Let us step back and talk about the role banks play in building an economy over time. In countries with strong banking systems, people can get mortgages and own homes. Businesses can get loans and grow. Entrepreneurs can borrow to start companies that create jobs. Access to credit changes what is possible for ordinary people. In countries without reliable banking systems, people store cash under mattresses. Small businesses cannot grow because they cannot borrow. Wealth stays stuck. Economic mobility is nearly impossible. The strength or weakness of a country's banking system has an enormous impact on the quality of life of its everyday citizens over generations. This is why economists pay such close attention to banking sector health in developing countries. When international organizations like the World Bank or the International Monetary Fund lend money to poorer nations, one of the conditions often involves improving the banking system so that credit can flow to businesses and households properly. Now let us talk about something a lot of people wonder about. What actually happens to your money if your bank does go under today? As we mentioned, in the United States, the FDIC insures deposits up to $250,000 per depositor per bank across different account categories. Most people have far less than that in any single bank, so they are fully protected. If a bank fails, the FDIC typically arranges a quick takeover by another bank. Most depositors barely even notice. They just wake up one day to find their accounts have been transferred to a new institution seamlessly. But if you have more than the insured limit in a single bank, you could potentially lose the excess amount. This is why wealthy individuals and businesses often spread their money across multiple banks or account types to make sure more of their funds fall under the protection of deposit insurance. Now let us talk about international banking, because money flows around the world in ways most people never think about. When a company in the United States pays a supplier in Germany, banks in both countries coordinate to make that transfer happen. International banking is the invisible infrastructure of global trade. The SWIFT network is the messaging system that banks use to communicate with each other across borders. It stands for Society for Worldwide Interbank Financial Telecommunication. Thousands of banks in over 200 countries use it to send payment instructions to each other. It is like the internet, but specifically for moving money. When countries fall out of favor with the international community, being cut off from SWIFT is used as a major economic weapon. Russia was partially cut off from SWIFT after invading Ukraine in 2022. This made it much harder for Russian banks to conduct international transactions and put serious pressure on the Russian economy. Currency exchange is another massive part of international banking. Every time money crosses a border, it usually needs to be converted from one currency to another. Banks facilitate these conversions and make money on the exchange rate difference. The global currency exchange market processes over $7 trillion in transactions every single day. Now let us come back to something personal. How do you make banking actually work for you, rather than against you? The first and most important thing is understanding exactly what fees your bank is charging you. Many people pay monthly maintenance fees, minimum balance fees, or overdraft fees without fully realizing how much it adds up. Overdraft fees deserve special attention. If you spend more than you have in your checking account, the bank covers the shortfall and charges you a fee, sometimes $30 or $35 per transaction. It is possible to rack up hundreds of dollars in overdraft fees in a single week without noticing until it is too late. You can opt out of overdraft protection on debit card purchases. If you do this, your card will simply be declined when you do not have enough funds instead of the bank covering it and charging you. Being declined is mildly embarrassing, but it is far better than paying high fees repeatedly. Another smart move is to keep a small buffer in your checking account above your expected expenses. Even keeping an extra $200 or $300 beyond what you need means that small surprises or calculation errors do not result in overdrafts. Think of it as a tiny personal safety cushion that saves you real money. When it comes to savings, the interest rate your bank pays you really matters over time. Many traditional big banks pay savings account rates well below 1%, but online banks and credit unions often pay rates much higher. Moving your savings to a higher yield account takes minutes and costs nothing to do. Credit unions are worth understanding as an alternative to traditional banks. They are not-for-profit financial cooperatives owned by their members. Because they do not need to generate profits for shareholders, credit unions often offer lower loan rates, higher savings rates, and lower fees than commercial banks. Membership is usually easy to obtain. Another thing worth knowing is how to read your credit score and why it matters so deeply. Your credit score affects not just loan interest rates, but sometimes also apartment applications, job applications in certain industries, and even the rates you pay on insurance. It touches more parts of your financial life than most people realize. The factors that build a good credit score are fairly simple. Pay your bills on time, every time. Keep the balances on your credit cards low relative to your credit limit. Do not apply for lots of new credit all at once. Keep older accounts open even if you do not use them often. On the flip side, the things that hurt your credit score are also predictable. Missing payments even by a few days, maxing out credit cards, defaulting on loans, having accounts sent to collections, filing for bankruptcy. These events can damage your credit score for years and cost you enormous amounts of money over time. Now let us talk about what happens during a recession and how banks behave differently. When the economy slows down, banks tighten their lending standards significantly. Getting approved for a loan becomes harder. Banks become cautious because they know more borrowers are at risk of defaulting when times are tough and jobs are scarce. This tightening of credit during a recession can make things worse. Businesses that need loans to keep operating cannot get them. They cut staff. More people lose jobs. More borrowers default. Banks tighten further. It is a self-reinforcing cycle economists call a credit crunch, and it can deepen recessions significantly. Central banks try to break this cycle by lowering interest rates and injecting money into the banking system. Making credit cheap encourages banks to lend again. Whether this always works effectively is debated, but it has become the standard playbook that central banks around the world reach for when recessions threaten to spiral. Let us talk about the future of banking because it is changing faster right now than it has at almost any point in history. Cryptocurrencies and blockchain technology have introduced the possibility of financial transactions that bypass banks entirely. You can send value to anyone in the world without a bank being involved at all. Some countries are even exploring central bank digital currencies, which are government-issued digital versions of regular money. These would be like digital cash, not stored in a bank but issued directly by the central bank. They could transform how money is created and distributed in ways that would have been unimaginable just 20 years ago. Artificial intelligence is also reshaping banking rapidly. Banks are using AI to detect fraud in real time, approve or deny loans in seconds, personalize financial products for customers, and automate back-office work that used to require thousands of employees. The bank of the future may look very different from what we know today. But no matter how much technology changes the surface appearance of banking, the fundamental purpose stays the same: connecting people who have money with people who need money, doing so safely, and taking a fee for making that connection possible. That basic function has been at the heart of banking for thousands of years. The key takeaway after all of this is that understanding how banks work puts you in a much stronger position in your own financial life. Banks are not inherently your enemy, but they are businesses designed to make money. The more you understand their tools and incentives, the better you can use them to your advantage. You now know more about how banks actually work than most people ever bother to learn. You understand where money comes from, how loans work, how banks make their profit, and how to protect yourself. That knowledge is worth more than any savings account. Use it well, and it will serve you for life.